very good afternoon to each one of you. On behalf of the Bangalore Chamber of Industry and Commerce and the HDFC Bank, we welcome each one of you to this webinar on the state of economy and Forex outlook. This session has been organized under the aegis of Banking, Finance and Corporate Affairs Expert Committee of BCIC and HDFC Bank. We like to specially thank Dr. K.V. Om Prakash, Chair of the committee and advocate and founder, Consortia Consultancy, Mr. Venkatakrishnan N., mentor of the committee, and Executive Vice President and CFO of Tata Hitachi Construction Machinery Company, and also Mr. Vivek Gupta, member of the committee, and the team from the HDFC Bank, especially on Vinay Kumar, Sakshi, Sarthi, Rajaram, for curating this session for the benefit of our members. Today's keynote speaker is Mr. Abhik Barua, Chief Economist and Executive Vice President, HDFC Bank Limited. A brief profile of Mr. Abhik Barua for the benefit of our members. He was formerly Chief Economist for ABN AMRO Bank and Indian Economist of Merrill Lynch, member Group of Economist Consultant by RBI on Monetary Policy and Finance Minister on Budget. A member of Working Group on the 11th 5-year plan, Standing Committee member of RBI Industry, Monetary Group, and National Committee on Economic Affairs, CII columnist for ET and Business Standard, commentator on all major news channels. Educated at New Delhi School of Economics and University of Maryland, USA. Recently consulted also by the Prime Minister on economic plan ahead. Thank you, sir, for taking out the time to be on this session. The session will be moderated by Dr. K.V. Om Prakash, Chairman of the Banking, Finance and Corporate Affairs Expert Committee. On behalf of the BCIC, we would like to express our sincere thanks to Mr. Abhik Barua for accepting our invitation to address on this important subject. We also would like to thank all the participants for joining to today's session. We also would like to acknowledge and thank HDFC Bank for being a supporting partner for today's virtual session. We would request all of you to post your questions only on chat box. The speakers will respond to the questions during the session, and in case time do not permit, we shall be sharing the queries to the speaker and shall revert back accordingly. May I now invite our president, Mr. T.R. Parshuram, who is a whole-time director and president of Toyota Engines India Limited, to kindly do a welcome address and share your thoughts on this today's sessions. Over to you, President.
Thank you, Mr. Prithvi. Very good afternoon, ladies and gentlemen. It's my pleasure to welcome Mr. Abhik Barua, Chief Economist and Executive Vice President of HDFC Bank Limited, for this very important webinar on the state of economy and Forex outlook. Friends, India has emerged as one of the fastest growing economies in the world, and it's expected to be one of the top 3 economic powers in the world over the next 15 years, backed by a very robust democracy and strong partnerships. India's foreign exchange reserves stood at US $581 billion in the last year, December 2020, according to the data from RBI. India is the 4th largest unicorn base in the world, with over 21 unicorns collectively valued at US $74 billion, as per the Arun Global Unicorn List. By 2025, India is expected to have 100 unicorns and will create 1.1 million direct jobs, according to the NASSCOM Zeno report, Indian tech startup. With an improvement in the economic scenario, there have been investments across various sectors of the economy. In 2020, the total deal value in India stood at US $80 billion across 1,268 transactions. Of this, the mergers and acquisitions activity contributed to 50% of total transaction value. Private equity venture capital companies expanded from US $36 billion in 2019 to US $39 billion in 2020. India's GDP is expected to reach 5 trillion by 2025 and achieve upper middle income status on the back of digitalization, globalization, favorable demographics, and reforms. All of us know India is one of the youngest populations in the world, and it's very, very important to reap the demographic dividend of this youth power for a constructive purpose to take the nation forward. India is also focusing on the renewable sources to generate energy. It's planning to achieve 40% of its energy from non-fossil sources by 2030, which is currently at 30%. And the country has plans to increase its renewable energy capacity from 175 gigawatts by 2022. India needs to increase the rate of employment growth and create 90 million non-farm jobs between 2023 and 2030 for productivity and economic growth, according to McKinsey Global Institute. Net employment rate needs to grow by 1.5% per year from 2023 to 2030 to achieve 8 to 8.5% GDP growth between 2023 and 2030. The union budget presented by the Honorable Finance Minister in the Parliament is well-balanced budget. Everyone would agree that the budget was presented under the unprecedented circumstances. FM has done the right thing by giving major push to the health and infrastructure sectors, even as she did not raise any new tax or increase the tax rate. This is a wonderful thing that has really cheered the industries and the markets. And finance minister has done the right thing by balancing the fiscal deficit and the growth of the economy. She has basically focused on the fundamentals and has resorted to increasing the finances through larger disinvestment program. Proposals to strengthen the tribunals, decriminalization of provisions in the Companies Act, easing compliances in small companies, OPC and LLPs, reduction of timeline of reassessment in income tax law, faceless tribunals, and dispute resolution committee for small taxpayers are all intended towards increasing the ease of doing business in India and improving the trust between the businesses and the government. It is laudable effort indeed, and we must all together work towards making India truly a Atmanirbhar Bharat in this direction. The budget's focus on growth, health, infrastructure, and industry is extremely good for the nation, and further setting up of mega textile parks is a welcome measure. Numerous foreign companies are setting up their facilities in India on account of various government initiatives like Make in India, Digital India, Skill India, Youth India, and the Prime Minister of India has launched the Make in India initiative with an aim to boost the country's manufacturing sector and increase the purchasing power of an average Indian consumer, which would further drive the demand and spur development, thus benefiting the investors. The Government of India, under its Make in India initiative, is trying to boost the contribution made by the manufacturing sector with an aim to take its GDP to 25% of the country's GDP from the current 17%. Besides this, the government has also come up with the Digital India initiative, which focuses on three core components, mainly creation of digital infrastructure, delivering services digitally, and to increase the digital literacy. India is expected to be the third largest consumer economy, as its consumption may triple to US 4 trillion by 2025, owing to shift in consumer behavior and expenditure pattern, according to Boston Consulting Group report. It is estimated to surpass USA to become the second largest economy in terms of purchasing power parity by 2040, as per the report by PricewaterhouseCoopers. So I would like to say something on a Forex outlook. Fitch Solutions has revised its forecast for the Indian rupee to average stronger at rupees 75.5 per US dollar in 2021 from 77 previously, and rupees 77 in 2022 from 79 previously, to account for a stronger 2021 forecast. Over the longer term, the overvaluation of the rupee in real terms and higher inflation in India vis-a-vis the dollar should exert a weakening pressure for the rupee. With India having a crude oil import dependence of more than 80% of its needs, rising global oil prices driven by a global economic recovery in 2021, will see a worsening of India's terms of trade and put depreciatory pressure on the rupee value. Brent oil is expected to average $53 per barrel in 2021 versus the 2020 year-to-date average of $43.18 per barrel. Meanwhile, positive news on COVID-19 vaccines as well as the US President-elect Joe Biden's victory at the November elections improved the risk sentiment and equities rose to new highs in many markets and Sensex crossed 50,000 for the first time. Considering still elevated uncertainty around the recovery outlook, given a resurgence in the COVID-19 infections in major economies in Europe, Asia, and record infection counts in the United States, markets may have been overpriced, but recent positive news has given a lot of positive corrections, and I hope that the trend will continue. The rupee's real effective exchange rate index shows that the currency is overvalued, trading 4.6% above its 10-year average. Current overvaluation will incentivize imports and drag on exports as they are less competitive than peers with more attractive valuations, hence pressurizing the rupee weaker. So this is a very, very hot topic because many organizations have been net importers and a lot of exports happening from this country. So the balancing this forex and hedging the risk is a great science by itself. And really you can make or break an organization if you are not able to play the cards properly. And there are several examples. Therefore, this seminar on this forex implications and way forward has come at the right time. I would like to compliment and congratulate Dr. Om Prakash, the chair and the co-chair mentor, Mr. Venkatakrishnan, and the entire team of Banking, Finance and Corporate Affairs for this initiative. We once again welcome one and all for this very, very important webinar. And I don't want to take much of the time between the cup and the lip. And now we have a great speaker today, Mr. Abhi Parua, the Chief Economist and Executive Vice President of Hdfc. And he has been a great veteran in this subject. And BCIC is very lucky to have got him today, in spite of his very, very busy schedule. Thank you very much, sir, for accepting our invitation. And it's a pleasure and pride to be with you today. Thank you very much. I hope this session will be a great session and you will have a lot of value and good takeaways. Thank you very much.
Thank you, President Parshuram sir, for this welcome address and giving us a lot of insight on the forex outlook and the what are the state of economy. Now, may I now invite Dr. KV Om Prakash to give a small context setting for today's subject and also moderate the session. Over to you, Dr. Om Prakash.
Thank you, Prithvi. And briefly, I will just set the theme. India is post-independence 75 years, striving and surging to attain a status of developing country, and it's already trying to at the diversity and also varied language barriers and adding to it the population. It is surging to be one of the most promising developing country, and it has set an benchmark in the developed countries and it's been classified as middle income developing market economy. And India is the 5th largest economy by nominal GDP, 3rd largest purchasing power, and as per IMF, as per the capital income basis, ranked 142nd by GDP and 124th by PPP in 2020. And as regards the forex, as our president was mentioning, forex is very important, and we need to have an outlook predominantly on the INR side. Indian rupee appreciation will help the importers and exporters. RBI as an controlling agency has been between the exporters and forex and has been monitoring and intervening. Let us hear from the expert, Mr. Abhi Barua. And Prithvi, I request you to kindly introduce the speaker for the day briefly. Hello.
Uh, Dr. Om Prakash, sir, I have introduced already. You want me to?
Already,
Already
that's enough,
completed.
right? Fine.
Yeah.
Over to you,
Over to you.
Mr. Over to you, Mr. Abik.
Right. Thank you very much. And Sakshi, would you be able to show the slides?
Yes, just a second, I'm sure.
We are just we I have a presentation, and I'm going to sort of take you through parts of the presentation. While my colleague Sakshi, who might actually participate in the interaction, puts this up. Let me just thank you very much for both inviting me and sparing time to listen to me. I will do this thing a little differently because I think a lot of very useful things have been said by the previous speakers. And since we are talking about the rupee, and the rupee does not move in isolation, but a lot of what happens to the rupee is a function of what happens to the dollar. So I'm going to sort of take a slightly different tack and tell you a little bit about what is happening in the global economy, and move a little to the budget, and talk then about the rupee. And I am perhaps not as convinced about some of the issues that were raised earlier, and I will also highlight some of the risks that are associated both with the budget strategy and the economic strategy going forward, so that it is up to you to appreciate both sides of the story. And Sakshi, if you just start with the first slide, please, which is on. I think what we all need to do is we need to first understand, if you were to get a handle both on India's economic prospects as well as the rupee, we need to understand where the world is headed. And clearly we are coming out very sharply from the doldrums of 2020. We are not, if you look at global output, we are not in a situation where there would be a prolonged recession or slowdown. And this is reflected in we are using the IMF projections, and you will see that while the global economy would have is likely to have contracted by 3.5%. Going forward, there will be a sharp bounce, 5.5% next year, and this year, I'm sorry, calendar year, and next year about 4.2%. So we are out, in a sense, out of the worst situation. I think for those of you who are in the export and import business, one of the interesting things about what is happening now, and this is something that we had feared, that global trade, because of the pandemic and because of the various restrictions that came on the back of the pandemic, global trade will remain subdued. You will notice, if you look at the chart that I'm showing you, global trade is also picking up. So it's good news for exporters and importers. But let us not underestimate the impact of the pandemic. So how do I evaluate the impact of the pandemic? I am going to ask you a question. So we are, before the pandemic happened, we were on a particular growth path, which was taking us to a level of GDP in 21, 22, and so forth. This is true for the global economy as well as for the Indian economy. If even with the kind of very spectacular growth that the president talked about, or the ones that I am projecting here, we are still we're going to be considerably below what we would have been in the absence of the pandemic, not just for this year, but for the next couple of years. maybe three years, maybe even 4 years. So that is something that there is a lot of damage that has already been done because of the sharp hit this year. And unfortunately, the deviation from this, what we would have been in the absence of the pandemic, and where we are likely to be, despite this high growth, is more pronounced for emerging markets like India. So while we should certainly cheer the fact that we are getting out of the worst slump, remember the first quarter contraction was about 24%. We are out of that. We are seeing good numbers. Companies are doing well. But let us not forget that their damage has been done. And this is not just for India, but for the global economy as a whole. But unfortunately, it is a little biased towards not just India, but emerging markets like India, this potential loss. Let's turn to the next slide. And so, for those of you who are wondering why, despite the kind of slightly gloomy picture that I presented of the global situation, that yes, it's recovering, but there is still, things are below, are likely to be below the pre-COVID trend for a while. Why is the stock market at 50,000 today? Why are commodity prices moving up so sharply? And the answer to this is that one of the key strategies in trying to tackle this crisis across the world, including the RBI, has been for central banks to put it in very crude terms, to pump in a lot of money into the system. And this money is circulating in the global economy. And any good news is pushing money towards riskier assets. The Indian economy, in relative terms, is considered to be or Indian stock markets are considered to be a riskier bet than, say, investment in Europe or the US. Emerging markets typically are. But so whenever there is good news, all this money is coming in and pushing asset prices up. So this is likely to continue, and I think we should draw comfort from the fact that, at least as far as liquidity is concerned, both domestic and global, and I say this for some of those of you who are doing borrowings abroad, who want to do ECBs and similar borrowings, global interest rates are likely to remain subdued. Turn to the next slide, please. One of the things the president mentioned, the new U.S. administration under Joe Biden, and one of the highlights of the Biden strategy is, again, very much like our budget, is that forget about the deficit for the moment. We will think about it later, but let us push in as much economic stimulus as possible. He's also looking at sectors like healthcare and infrastructure. So we have similarities with the US. And so it's a temporary jettisoning or abandoning of concerns about the fiscal deficit, fiscal situation, etc., and going for an all-out stimulus. So one of the things that has happened as a result of this, which is happening both in the US and India, is that as you spend on the back of increasing debt, if the government comes and borrows in the market, yields tend to go up, bond yields tend to go up. And US bond yields have moved up, so have Indian yields. But with the US bond yield moving up, typically, this is a support for the dollar. So the dollar has actually started, if you've noticed, rising at least against the major currencies like the euro. So today the euro has dropped below 120. So I will get to the story a little later. Turn to the next slide, please. Sakshi, the next slide. Yes. Um, there are problems. I mean, one of the things, as I said, about liquidity is that it tends to push up the prices of all assets. Now, commodities are basic today have become like financial assets, right? You invest in commodities from a financial perspective as an investor. So the same thing that applies to the Indian stock market also applies to the price of copper, applies to the price of crude oil, applies to the price of steel. And so if there is so much money coming, being printed by global central banks, these commodities are likely to move up sharply, and indeed they have. And as Mr. Parasuraman mentioned, that this is going to be a bit of a risk for the rupee going forward. Having said that, we've noticed some softening of prices, not of oil. Oil has supply side issues, but things like copper, steel, and aluminum, because people are a little worried about the growth in China, which was kind of assumed to be very strong because they had come out very sharply from their COVID-induced slowdown. But now, with the second wave of infections, there is some concern about that. Turn to the next slide, please, very quickly. Sakshari, yes. Now, let's just now get to the heart of the problem. In all exporters were kind of taken by surprise. If you remember, in when the pandemic hit us and there was a lockdown, and everyone said the rupee was moving maybe to 78 to the dollar or maybe 80 to the dollar, and everyone was so bearish. And let's not. This should be a recent memory and fresh in our minds. But suddenly things changed, and the rupee started gaining and continued to gain. Where we thought that 75, it would stop at 75, it didn't stop. It dropped below, and there was continuous RBI intervention. And today's at around 73. So what happened? Now, as I said, that you can't look at the rupee in isolation. You have to look at it in terms of what is happening to the dollar. And for the whole of 2020, the dollar showed a continuous decline. Now, is this exceptional? Perhaps not. And as this chart will show you, and if you're not, if you can't follow the chart too well, let me tell you that the dollar is prone to, and those of you who have been in the FX markets or have hedged and been taken FX loans or exported would remember that we've seen phases of prolonged increases in the dollar, which happened from the mid 2000s and mid 2010s, and we've seen periods of continuous decline in the dollar in the early 2000s. So the dollar is prone to very long up cycles and down cycles. Now, the view that was being formed towards the end of 2020 is that the dollar was in for one of these long-term phases of a decline. And if the dollar, I mean, it's simple, logic of exchange rates, that if the dollar keeps declining, the rupee will tend to appreciate. And the one way, forget about everything else. If you want an explanation as to whether the rupee will, appreciate, depreciate going forward, you have to answer the question as to what will happen to the dollar. Now, the view at the end of 2020 was that the dollar was going to continue to decline because it is prone to get into these phases of long-term gains and declines. But that I think has slowly changed. One of the reasons for this has been the advent of the Biden administration. And today we are possibly looking at the dollar kind of bottoming out, consolidating, and gaining a little bit. So that fear of a continuous decline in the dollar has abated a little. But we are not seeing a very large turnaround in the dollar. So, contrary to some of the expectations that people have, that the rupee is in for uh, considerable depreciation. If you're talking about a 77 levels, it's 4 rupees from current levels. I would think that that is unlikely. I would tend to believe that if the dollar does not appreciate too much, as we don't as we expected, then the rupee will kind of remain range bound. And betting from an exporter perspective, betting on a 75 plus or 77, I think might be a risky decision to take. Let's turn to the next slide, please. So here, I mean, this is basically summarizing what Mr. Parasuraman said, and there are two issues here. Yes, of course, the current account will go up. Oil prices are moving up. There will be some, pressures coming from that. The current account would widen. But on the other hand, don't forget that life is not only about the current account or the trade balance. There is a huge capital account which is there. And with so much money sloshing around in the system, and with a strong budget, which is likely to attract capital and capital apart from just equity flows, because today you have a situation where you have a new entity which is going to bring in capital for infrastructure projects through investment trusts. You have a potential, privatization play where foreign capital will come in. It's really a balance between these two things that you need to remember. And this is again related to what I said about the dollar, that while the dollar might just consolidate, not fall sharply from these levels, it's not going to turn around and start flying. And that if that doesn't happen, I if you look at it from this perspective of the balance between capital flows or generally flows into India and flows out of India because of higher oil prices, commodity prices, and so forth, I am not very sure that the rupee is going to depreciate significantly from these levels. So I would, my advice for you would be to be a little careful. We put a number of 72 half, 73.30. Perhaps that will, it could be between 73 and 74, but certainly going beyond that will take some doing, and let's be as cautious about that scenario as possible. Well, there are certainly risks emanating from the budget. It's all very fine to spend a lot and borrow. There is a concern about the fiscal health, which might push rating agencies to downgrade. Maybe the market will completely ignore it, but it is a slight concern for the rupee. And there are inflationary risks which would build up, which are typically negative for the rupee. But despite that, I see it sort of kind of settling around the 73, 74 levels, maybe moving to 74 half, but move beyond that is going to seems a little difficult given the configuration of factors. And the other things, actually, if you turn to the next slide, is that look, all this while we had the RBI intervening in the market and holding the rupee. Otherwise, maybe in one of those phases, the rupee would have gone to 71 or 72 very easily. The RBI kept buying dollars to prevent the rupee from appreciating. I think the RBI's ability to buy dollars and prevent rupee appreciation is limited. Maybe the dollar stability will take care of things. Maybe the higher oil prices will take care of some of the pressures. But if there were more pressures to build up on the rupee, the RBI's ability to intervene is significantly lower, and that is because of two things. There is inflation, which is building up in the Indian economy, and inflation, as you know, is often associated with too much money in the system. So what does the RBI do when it intervenes? It buys dollars and releases rupees into sells rupees, or releases rupees in the market, which adds to rupee liquidity. If there is an inflation risk, the RBI might not want to do it as aggressively last time. This is something that you need to bear in mind. And number two, let's not forget that we are on the list of currency manipulators for the US Treasury. The new US Treasury Secretary, Janet Yellen, who was formerly the chief of the Fed, has said that, look, I'm not going to tolerate any of this currency manipulation business. So I think at some level, the RBI will have to cool down its intervention efforts. So, the rupee is overvalued. There's no doubt about it. It's possibly 25% overvalued if compared to the base of 100. But it has remained overvalued for long periods without a correction coming through. I think that really broadly summarizes my take on the rupee. Let's just turn to the next slides very quickly. And these are my comments on the budget. I think this was a very, very major shift in strategy. We started by the pandemic period by being fiscally very conservative. We were one of the lowest, in terms of fiscal stimulus and support. And suddenly there has been a change, which is very welcome. I think a lot of economists, including myself, have advised greater fiscal expansion. That has been done. I think we see also politically an old avatar of the BJP, the Vajpayee era of the BJP, market friendly, industry friendly, business friendly, bold in terms of taking on actual privatization instead of selling bits and pieces here and there. I think it's doing, as the president mentioned, a lot for health. It's trying to rope in the states to spend big. And I think it's ultimately sort of working towards this infrastructure push, is working towards the China plus one model, which the global economy might move to, where you're looking for an alternative sourcing base to China because of the various problems related to China. The COVID virus being one of them. And we want a place at the global table. And if indeed we can push through some of these infrastructure initiatives, we might sort of get there and become a manufacturing powerhouse and an alternative to China over a period of time. I think the bad bank, as a bank, from a banking perspective, I think there are implementation issues. The government is taking a bit of a hands-off attitude and approach towards the bad bank. But once it's there, it will make a huge difference to the banking system. But again, as I said, let's just turn to the risks. Let's just skip the slide and just let's move to the risks. And I'll just stop with this. Look, I mean, I'm an economist, and I have this unpleasant task of highlighting some of the risks for you. Inflation is a big problem. And if you have a combination, and today, despite the contraction due to COVID, inflation has been high. And let me remind you, it's not just a food or a vegetables problem. It's been noticed in a number of items, which technically constitute core inflation, which means inflation that is kind of embedded in the system. And we've seen inflation in services, we've seen inflation in number of goods, and this inflation pressure is likely to build up if you have easy money and easy fiscal policy. We've already seen government bond yields start moving up very, very sharply. And if government bond yields move up, interest rates are likely to move up. So I think from a borrowing perspective, for those of you who are looking at bank loans, perhaps clearly seen the bottom of the interest rate cycle. Tomorrow, the credit policy is there, but in the presence of such elevated inflation, uh, it is not possible to cut rates further. And if government bond yields move up and the RBI tries to control inflation by tightening liquidity a little, it's a combination where yields and interest rates could rise. Finally, I'm very encouraged by the efforts towards infrastructure and the creation of new institutional mechanisms like a new DFI. But investing in infrastructure hasn't been a particularly pleasant, let me sort of be blunt with you, hasn't been a particularly pleasant experience for most investors. There are very few projects and areas in which money has been made. And you can talk to anyone across the spectrum, whether it's private equity or bigger funds, infrastructure stockholders. It really is a difficult game to play. I just hope that the announcements in the budgets will also ensure that there is enhanced risk appetite. And finally, I think we are putting a lot of assets. We're planning to put a lot of assets on the block. I just hope that there are enough buyers for it. Privatization is a very, very desirable objective, but I think it has to be, the execution becomes very important, especially when you're saying that you're going to sort of get rid of all your private sector units in the non-strategic sectors and just hold on to a couple of them in the strategic sectors. To make the broad point, and Sakshi, can you turn to the previous slide where we showed the deviation from growth? Growth is doing very well. We will have a good growth number for the next fiscal year. It's going to be maybe 10% in real terms, 14%, 14.5% in money terms, as the budget has assumed. But I think the budget was so bold and decided to put aside this very cautious approach, this very calibrated approach, and take a much more aggressive approach to the economy, simply because of what I said earlier. And this chart hopefully will capture what I was trying to say. The red line is where output or GDP or whatever you call it would have been if COVID hadn't hit us. We took a hit in fiscal 2021 and this fiscal because of COVID. And even with very, very high growth this year and reasonably strong growth in the coming years, we will remain below the pre-COVID path that we had set for ourselves. So the idea is to crunch and make this the difference between these two lines as small as possible, so we get back to the pre-pandemic path. So the $5 trillion challenge, etc., has to be pushed back by a few years because there is a lot of repair work that needs to be done, and let's not forget that. And I personally think that in terms of the strategy, there could have been different approaches to repair. But in terms of strategy, I think what the budget did is perhaps the optimal or the best strategy going forward. There is a big challenge. We need to recognize that challenge. Hopefully, we will, meet this challenge as aggressively and as effectively as possible. I will stop here and I welcome questions.
Thanks, Abhik, for this wonderful presentation you made and brought a lot of insights for the. May I now request Dr. Om Prakash to kindly take over?
Yeah, that was a wonderful insight which Mr. Abhik had brought in, especially the word queen looks very nice. And uh, as regards the RBI, expectation from RBI bi-monthly monetary policy to be announced later this week. You have any idea about that, sir?
Tomorrow. So, as I said, Dr. Prakash, today we face a huge problem. Inflation, unlike other economies, inflation has started picking up. And it's not just due to the rising prices of tomatoes and potatoes, right? There is a more underlying pressure, which is inflation pressure, which is there, right? So, in the presence of inflation, it is difficult to cut the policy rate. So, let us forget about any cuts in the policy rate. The RBI actually has, in between, said that this huge amount of liquidity that it um, injected into the system after COVID hit us, they will try and normalize that, which is reduce that. But it also has to meet the challenge of supporting a very, very large government borrowing program because of the fiscal deficit, as I mentioned, because the fiscal deficit is going to be 9.5% this year. So additional borrowings of 80,000 crores and 6.8% next year. This is a huge amount. So it's a major challenge for the RBI. So no rate cuts, you know, maybe a continued move to keep liquidity a little lower than it has in the past, take a chance with government bond yields, and perhaps more specific intervention in the government bond yields market to prevent some of the yields going forward. For companies, it means that perhaps certainly your short-term costs have gone up, CP rates, commercial paper rates have gone up, and so forth. Your other rates will move up. So I think we've seen the bottom of the interest rate cycle, and that is what fair. I mean, we are coming out of the extreme phase of COVID, and as you recover, the price you pay for that is higher borrowing costs.
Mr. Abhik, thank you very much. This Paraya. I think very, very interesting insight you have brought in. I think a 360-degree view. I think you could bring the big picture very, very nicely. So I have two questions. The first question is the FM is talking about a fiscal deficit of close to 9.5 this year, then consolidating 2026 to the tune of less than 4.5. Meaning the bonds market is going to really attract, and meaning the interest rates are going to go up. So between this zone, 2021 and 2026, what fluctuations you could see in the interest rates in a kind of a ballpark? That's the question number one. And question number two is more interest means, again, people will have get more interest for the savings, which means the more money in their hands, again, more of liquidity into the system. This is again going to increase inflation. So this cycle is going to be a bit vicious cycle. So what kind of RBI interventions you anticipate in the near to midterm?
I think you hit the nail on the head, Mr. Parasuraman. And I think we are now going in for a phase of perhaps elevated inflation or elevated inflation risks going forward. We also have very large government borrowings because the fiscal deficit is high. So I think the interest rate cycle has turned up, and you should expect, as the economy recovers further, um, perhaps higher and higher interest rates, maybe not very sharp increases every time, but directionally we are moving northward. So we will I think, be prepared for higher interest rates going forward. The RBI will um, hold, try and moderate the increase in certain interest rates, like the 10-year bond yield for the government, because otherwise borrowing for the government will become very expensive. But it will not do uh, the kind of things that it did in the COVID period, because we are recovering, and the more money you put in, the more liquidity you put in, more the inflationary pressure. I think today the baton has passed from the borrowers, who enjoyed exceptionally low borrowing costs, now to the savers, who will finally get a better return on their savings. And this is a medium term view from my side.
Mr. Abid, do you think that we will be crossing 10% levels in the next 2-3 years?
10%. What are you?
On interest rates.
Well,
bank
if
interest rates.
So if I were to look at the government bond yield, the 10-year bond yield, which is roughly around 6.1% today, I would say that by the end of the year, you might be looking at between 6 quarter and 650. So depending on your credit rating and whatever the company is, you will see similar increases in your cost. So if you are borrowing at, say, 8%, by the end of the year, you might be borrowing at 8.5%. For a company that was borrowing at 10%, you might see it borrowing at 10.5%. But that said, there is one offsetting effect. As the recovery picks up, there is more risk appetite. So the risk premium on especially the AA and the A companies will tend to go down a little. So that is some offset to that. But you have to be prepared. For this year, I would say be prepared for maybe a 50 basis point jump in interest rates, in your effective interest rates, whatever you borrow at. And then let's see how it goes. But you should be prepared for more increases going forward. As I underscored and highlighted, this is not a dramatic increase. You're not seeing a 1 percentage point jump or 1.5 percentage. I'm saying 50 basis points, half a percentage point. But be prepared for that. That's very critical.
Kind of a painless surgery.
Well, no surgery is painless, so there is going to be some pain. But I'm saying the pain will be there will be some anesthesia there.
Thank you, Mr. Abid. Thank you so much. Thank you.
There's one question which has come up in the chat. Mr. Ravichandran, you are there? Well, let me post this question. With a good recovery and good, Ravichandran, yeah, you can ask the question directly. Please unmute.
Om Prakash sir, you can read it out, sir.
Yeah, okay, fine. The question is like this, 1 minute. With a good recovery and good budget and increased sentiment in the market, do you think investment by private sector in infra and other sectors increase?
I hope so. And I think the government is doing its best. The private sector has been very cautious about investing in infrastructure, as you know. And there have been anyone who has lived in India for, say, the last 25 years would have known the various problems faced by infrastructure investors, particularly the private sector. The PPP as an idea has not taken off. Hopefully, and because of the way this infrastructure projects are being sold through investment trusts and so forth, you will attract a new class of investors, and the private sector will feel more confident about investing in infrastructure. But as I said, infrastructure has been a very risky area, and let's not forget that. But I'm hopeful that this time there will be considerably more private interest in infrastructure than in the past.
And another question is, what is your view on the global currency, especially the Japanese yen and euros?
Euro, we are expecting between 120 and 122 or 123. And Sakshi, would you come in on the? I'm just going to ask my colleague because she just did a yen forecast. Sakshi, what is our view on the yen?
So, near-term view on the yen is between 104 to 106. And by the end of this calendar year, we are expecting a move between 107 to 109. That is basically making the assumption that there will be an improvement in this sentiment, and the safe haven demand for the yen will either off and put pressure on the Japanese currency.
So, if there are no other questions, we will. It's past 5, so we will bid you farewell. And if you have any other queries, you can mail it to us, and we'll be happy to get back to you with detailed answers. And thank you very much again for having us, having me, and this interaction. It was I think, very fruitful from my end, and I hope you found it useful too. Should we, Mr. Parasuraman, should we, Mr. Dr. Om Prakash, should we?
I will formally close the meeting.
Yes.
May I
Dr. Om
have,
Prakash, I had two other questions. Sorry. I had two
before
other
the vote of
questions.
thanks, can you do the honors?
Yeah, yes, sir.
I think we just crossed 5 o'clock. I think it's not fair to stretch the time because this time is very valuable. So can you note down the questions and we can probably seek the clarification later?
Certainly, we will get back to you with answers, as soon as possible.
Sir, but definitely you have brought a fantastic image of 360-degree view. I think you're just trying to touch upon the budget, the current situation, and going forward. And definitely it should be an eye-opener and very, very value-added session for all our member friends.
Thank you.
very
Thank
much,
you.
sir. Om Prakash would like to, yeah. Dr. Om Prakash.
Thank you. Thank you very much. Thank you. Thank you. Thank you.
I thank everybody who attended this wonderful topic on economy and forex. I would like to thank Abhi Barua for bringing a wonderful insight about the whole topic and also enlightening us on the future Indian model. And I thank the President, Mr. T.R. Parshuraman, for having participated and extended his support, and the BCIC Secretariat, and the team HDFC for bringing out this wonderful program and also sponsoring it. Thank you very much, and thank you all the participants for this wonderful program. Thank you very much, sir. We'll keep in touch with you. Any
Yes,
queries, we will
certainly.
definitely.
Certainly. Thank you. Pleasure.
Thank you.
Thank you, sir.
Thank
Thank you
you.
so much.
Thank you. Thank you.
Thank you all, sir. Thank you.